We're talking about low rates, we're talking about low inflation, and we're talking about low growth. Talk to me about that third point there. What's your outlook here for global growth right now?
Well, I think global growth, as we all know, has slowed a lot over the last 2 years. Last year, 2019, was the year when the US joined in the slowing. So US growth has slowed as well. We think the outlook for this year is that we are seeing some bottoming in global growth first, and that seems to be happening as we speak. So some of the near-term leading indicators have started to turn up, like the global PMIs. The interesting thing is this is happening outside of the US first. The US is kind of lagging the global cycle. The US was lagging on the downside, so it started to slow later than the rest of the world. And I think what we'll see this year is that the US will still be slowing, at least in the first half of the year, while the rest of the world is picking up. And then the US will probably only join in this mild economic recovery in the second half of this year. So the world leads, the US lags.
Joachim, you used that word mild, and mild growth has really been the watchword for basically a decade now, whether you're talking about the U.S. or the world. And that has really been a wonderful sort of Goldilocks environment for investors who have found ongoing growth without much threat of tightening from central banks. So is there any reason to think that that sort of a state of nirvana that we've seen for investors is going to change anytime soon?
Well, you're right, Joe. I mean, in the last 10 years, we've had a pretty below par, bumpy and brittle recovery, right, or expansion, a triple B expansion, as I called it many years ago. And we've had a triple A liquidity cycle where liquidity was abundant, it was augmenting, it was ample, and that's driven valuations up across asset classes. So you're right, it was a great decade for investors. It was not such a great decade for the economy. What we're seeing now is we'll see the continuation of this bumpy, below par and brittle expansion, but valuations are very full. So I don't think we can bank on a continuation of what you've called nirvana for investors, quite the opposite. I think we've now entered a period where it becomes more and more difficult, for returns to stay as high as they've been. We're looking for much, much lower returns in the next few years. Our secular outlook for the next 3 to 5 years is for more disruption to happen, so more volatility, more shocks to hit. And that means the next 5 years for investors will be very, very different from the last 5 to 10 years.